All right, well, thanks. And welcome to everyone, and thanks for attending. I appreciate it. And today we're going to talk some pretty cool stuff about taking some trading entries, things you might be doing already, and kind of supercharging them, adding a little to them, or maybe it's taking away from what you're doing now. So it's going to be pretty interesting. So I want to thank you for joining me. And I'm going to talk about today good and bad things you can do to entries. A lot of people kind of just come up with entries and kind of take certain things for granted and always do certain things, and it can really change the strategy results that you see. So I'm going to give you three concepts. We're going to talk about them in some detail, things you can immediately put to your strategies, assuming most of you are going to be like algo trading and trying to trade with some rules. And the results I'm going to show you today are actually based on over 115,000 different strategy tests. So 115,000 back tests that I ran specifically for this webinar today. So it's a lot of data that I had to crunch to kind of come to the conclusions I'm going to be showing you. And kind of as we go, I'm also going to be talking about a strategy development framework, to build these strategies, to take these entries and these exits and to put it all together if you want to do it yourself, because that's a really important part of all this. So first, you've probably seen this disclaimer a million times, but don't trade with money you can't afford to lose. Past performance not indicative of future results, and unless the results happen in your own account, treat them as hypothetical. And so that means you may or may not get the same things happening in your account. So probably a lot of you know who I am. For those of you who don't know me, just to give you a real quick background on me, 3 years in a row, I finished either in first or second place in a real money year-long trading contest. And each of those years, you can see the percentages at the bottom. I had over 100% annual return. So I've been able to take what I do and actually apply it and put it out to public scrutiny. So keep that in mind as you listen to people talk and as you see things on the internet. A lot of people can say things that aren't necessarily true. There's a lot of paper traders, for example, who they always seem to get caught eventually. This was actually a year-long real money contest, so keep that in mind. And I've actually written 4 books. They were all bestsellers on Amazon at one point or another, and the one at the bottom is actually a bestseller. It's been the bestseller in either futures trading or algorithmic programming for about the past year. So if you get a chance, you might want to check it out. So you saw some of my trading results. I talk about a lot of trading things in Technical Analysis of Stocks and Commodities magazine, and I actually won a Reader's Choice Award in 2020 for the best overall article. It was my monthly article, my monthly column. And if you have questions for me that I might be able to answer about algo trading, feel free to send them to me. Maybe I'll put them up in an upcoming issue. So I mentioned, I've had my own success. I've also been able to teach people, and so far I've been able to teach 6 trading contest trophy winners, and my students in a workshop I teach have done really well, created a lot of strategies, and that's a group picture taken at my house a couple years ago. So anyways, the point is I have a good trading background, a successful trading background, and I've also been able to teach it. So enough about me. Let's kind of jump into it. And what I'm going to do is take you through the steps with a real simple strategy, and we're going to kind of be doing some stuff to it and kind of look at the results. Does it make it better? Does it make it worse? That's kind of what we're going to be looking at. So first, let's just take a simple breakout strategy. You know, you've probably all seen these before. This is written in TradeStation easy language. You're just buying the next bar at the highest high of a certain number of bars back on a stop, and you're selling short. So just by itself, it's just a simple 2-line code. You know, if you don't have any stops or targets or anything like that in it, because when you buy, you're reversing any short signal or short trade you're in, I should say, and you reverse the short, go long, and then when you sell short, you exit the long and then go short. So it's just a stop and reverse type system. Pretty simple, but it's a good basis for looking at what we're going to be doing here. So I take that strategy and, hey, you know, these are basically just entries, right? So can we make it better, or can we make it worse? And you might say, well, why why would I want to make it worse? Well, I think you'll find out why as we go through this, because sometimes making something worse gives you some insight into what not to do, right? And that becomes pretty informative too, as you'll see. So I'm taking those entries and I'm going to run a 10-year back test, 10-year historical test. It's going to run from 2010 to 2020. I'm trading 40 different futures markets. So I'm looking at a whole range, you know, everything from the indices to currencies to interest rates to ags, softs, you know, the whole gamut of every sector. Usually there's 3 to 5 markets or instruments in each market sector. So 40 different markets. I'm going to look at different bar sizes. So I'm not just looking at daily bars, but I'm also looking at 60-minute bars. I'm trying to look at a wide range. And, you know, the idea here is by running such a broad test, you can actually get a lot of insight into the markets in general and system building in general. And that's kind of what I hope to do today, is to give you guys some stuff that you can walk away with that will help you improve your existing strategies or create new ones. So I'm including slippage and commission. It's different for most markets. You know, the slippage for coffee isn't going to be the same as the slippage for the mini S&P. It's a definite must to include these. I can't stress that enough, because I could show really good results if I didn't include slippage and commissions, especially the slippage part, because that's the bigger factor. And if you've looked out there at things, you know, that people are selling, systems are selling, or education or whatever, a lot of people don't include slippage. And it blows my mind, because when it comes down to it, most trading systems, when you don't have slippage and commission, guess what? They make money. But once you include slippage and commission, it kills most trading systems. So keep that in mind as we go through here. It's going to include slippage and commission, so they're built in. Now I'm going to use different lengths for the breakout. Remember, I had that as a variable, so I'm going to use a short, medium, and long-term length. And I'm not going to try to optimize for that. I'm just going to kind of sum it all up and take the results for all 3 of those. So I'll show you in a little bit. One of them tends to be a little worse than the other ones, but I want to include that in there. So I'm trying to have a wide range of values there. And that's because I'm not looking for the best case, you know. It's pointless to look for the best case. I'm looking for overall tendencies and overall just kind of generalizations you can make about things. And I think you'll see at the end of this, you'll sit back and say, wow, yeah, he was actually able to do that, and gives me some good things to work with. So, how do I evaluate all these? I'm going to look at return on account. It's not the best metric, but it's certainly better than net profit, which is what everybody likes. Everybody wants to know how much profit. Well, when it comes down to it, the net profit's only important relative to the drawdown you have to endure. I'm sure we've all seen great looking trading systems that made a lot of money, but also had horrendous drawdowns, and you probably wouldn't want to trade them, or you couldn't trade them psychologically because of those big drawdowns. So return on account is a metric that includes the net profit and includes the max drawdown. So it's a good number to use, and so that's what I'm going to use here. Okay, so let's first take a sample trade just so you can kind of visually see what we're talking about here. Every bar, it says buy the next bar at the highest high if it hits the highest high, and that would be on this bar right before the buy bar. That's your, you place the order for the next bar, and lo and behold, I believe this is a 10 bar high. It hit there and it bought, okay, just like we want it to, and that stays in the trade until it hits the 10 bar low, and then it takes a short trade. So it just follows that channel, and every time it hits that channel, it buys or sells short. Pretty simple, right? That's without any kind of stops and targets and anything else. That's kind of how it looks. Okay, so let's just look at all those results, all those markets, all those bar sizes. Let's just add them all up, average them out, see what we get. And here's what you get. If you have a look back length of 10, you actually on average lose money. Okay, so it's too short of a breakout length. When you start getting to the longer lengths, you get better, okay? Quite a bit better. And yeah, 25 and 40 look back length. So if it was a daily bar, that would be a month to a month and a half high or low, okay? But if it's a 60-minute bar, it's a higher low of the last couple days. So anyways, that's kind of where we're starting from, just that simple strategy. If you add them all, if you average them up over all the lengths, which is what I'm going to be showing from now on, you get an average return on account of 3.84, okay? So that's just going to be our baseline, and you'll see that number pop up from here on out. But that's what we're comparing to. Can we do better than that? And if we can, how? Or do we do worse than that? How do we do it? Because we're looking at both, trying to improve the entry and also how to make it worse. Okay, so I'm going to look at 3 different approaches to significantly change those results. I'm going to look at stop loss and profit targets as exits, put those in that strategy. I'm going to look at adding some standard indicators, things like RSI, ADX, you could do stochastics and all other sorts of candlestick patterns. You could do all sorts of things here. But I'm going to look at a couple of those. And then I'm also going to look at a bull and bear regime filter, meaning, hey, if I'm in a bear trend, I only take short trades. If I'm in a bull trend, I only take long trades. So we're going to look at each of those in turn. So let's look at the stop loss and profit target first. Okay, so first of all, the strategy I showed you was just 2 lines, right? It was just a simple breakout buy, and a breakout sell short. Most people right from the beginning put stops and targets in there, as must-haves. They say, oh, I've got to have a stop loss. I've got to have a profit target. Okay, well, what that means is every time they're evaluating a new entry or a new strategy, they always evaluate it with those stops and targets in mind, okay? Well, the question to ask yourself is, what if that stop loss is really hurting you? What if that profit target is really hurting you? What if it makes the performance a ton worse and you didn't even realize it? And I know for some of you, you're like, wait a minute. He's saying get rid of stops and targets? Well, I'm saying maybe you should look at it and see what it does. Because maybe your entry was really good and it was the stop that killed you. You don't know, right? Unless you test it. And that's my point. Be careful if you always include stops and targets. That might be part of the problem you're having. If you're having problem finding profitable strategies and profitable entries, might not be your entry at all. Might be your stops and your targets. They might actually make performance worse. Of course, they might make it a ton better. So let's see what happens with this one. So first I'll look at profit target. Now this is TradeStation easy language. I apologize for those of you who don't use TradeStation, but I've been using TradeStation for over 15 years, so that's kind of how I program. So it's just a simple line of code in TradeStation, set profit target to some dollar value. And I'm going to vary that. And you can kind of see if, let's see, I can do a pen here. So I either have a $2,000 profit target, a $3,500 one, a $5,000, which is kind of big. And I want to see how having those profit targets change things. Now remember, with no profit target, basically unlimited profit, I was at that 3.84 for average return on account. And here are the results. So if I have a real small profit target, I can actually turn that strategy into a net loser across all the markets, okay? So that means, hey, if you're cutting your profits too short, that's bad. And think of that as the trend is your friend kind of thing. You don't want to just take a little bite of the apple when you could have a whole bunch of the apple. That's what this is saying. So that's not pretty good, not really good at all. And then as you go up in your profit target, your results get better. And actually, $5,000 profit target per contract. So that's a big move. That's 100 ES points. That's 100-point move in soybeans. It's $50 per ounce move in gold, for example. Those are pretty significant trends. That's where you want to be. But overall, if you just look at them as an average, it actually hurts your performance. So what it's saying is, hey, it might be better not to even have a profit target, okay? Now, does this hold for every single strategy out there? Probably not, but the point is it holds for a very popular one, which is a breakout strategy. A lot of people trade breakouts. So this is saying, hey, don't limit your profit with a breakout strategy. It might not be the best way to go. You actually get worse performance the more you try to throttle your profit. So that's kind of interesting. So it's not exactly a way to supercharge the breakout strategy, but if you had the profit target from the beginning, it's a way to really make it better. You take out that profit target. All right, so what about stops? Let's take a look at stops. Again, it's a simple line of code. And once again, you can see I have different stop loss values. I have $1,000 up to $2,500, and compare that to no stop loss, and your results are a ton better with no stop loss. Now, I know this probably scares a ton of people, okay? Whoa, no stop loss. Oh, my risk is unlimited. And, people get scared about that. I understand that. Most of my strategies have stop losses in it, even though it does make the performance worse. Some don't. I know some professional firms, CTAs, commodity trading advisors, a lot of them, since they're trading so many different systems, they actually don't have stops because, the theory is, how many times have you seen the market move against you, hit your stop, and then take off in your original direction? That might be what you're seeing here. The stop loss a lot of times just hurts you. Now, there could be great psychological reasons for having stops, but from what I've seen, a lot of times it's not necessarily a financial reason. And, especially for this strategy, having a stop loss of even $2,500, which is, that's a pretty big size stop loss to have for a single contract, that doesn't really help you too much. And in fact, it hurts. It hurts a lot compared to having no stop. So the bottom line, as far as improving what you're doing, hey, if you're using stop losses and profit targets, they realize they might be killing whatever great entry you've come up with. And it's worth testing to see if you still want them. So one thing you can do is take some of your existing strategies and see what would happen. What you might find is maybe your worst case loss goes up a bunch, maybe your average loss goes up, but a lot of times maybe the reverse signals might make things where they're not that bad, where having that stop might not be doing what you really intend it to do. So, I don't want to start a big controversy of, hey, Kevin says don't use stops, because I'm not saying that. I'm just saying it's worth looking at. Question some of those assumptions. People always say, hey, don't use a stop loss, always use a profit target. Well, maybe you should test it for yourself and see. And you might decide you still want it, even though performance-wise it makes things worse. Hey, that's fine. Not every trading decision has to be financial. You have to have something that fits your personality. And if you think you feel better with stops and trading a system with stops, hey, then, go for it. So what most people do when they're trading, they use standard entries, the canned entries. They take all their data, they throw it in an optimization engine, and they select the best parameters and start trading. And certainly you could do that with your standard, with the other, whatever entries you come up with. I'm saying there's a lot of mistakes here that we could talk about. There's 5 right there. Don't do this. Learn to test intelligently. Okay, so let's move on to the second one, which is just using some standard indicators, okay? And the idea behind this is a lot of people think they need to filter things. So, they'll run their initial test and they'll look at a chart and see some really dumb looking trades, right? There's always dumb trades. and they'll say, I got to filter those out. Oh, maybe if I use XYZ filter, it'll eliminate some of those bad trades. Okay. The question is it a way to supercharge your strategy or your entry, or is it a way to make them super stink, to make them worse? That's what we're going to kind of look at. So the first one I want to look at is just an ADX filter. So ADX, usually what people say, hey, if it's above a 20, you're in a trend. If it's below 20, you're not in a trend. So I'm going to play around with that level. So I'm going to say either a 10 is a trend and above, or 20, but that's generally what people say. So here's an example where you hit a higher high. Let me highlight it right here. But since you're below the trend threshold, it doesn't take a long trade here. It takes it when it thinks it's in a trend. Okay, so the idea here is you don't want to get in, you don't want to be taking trades when you're in the chop. You only want to do it when there's a defined trend. Okay, fair enough. It makes sense, right? Whether or not it works, we're going to see. And there's those examples of it. Okay, so here's the code for it. I just I say if the 15 period ADX is above a certain threshold, either 10 or 20, then I can do my little breakout trades. So here's the results. And again, we're looking at the 3.84 as our baseline. And look at that. It actually says, hey, if you wait till the trend's pretty well established by the ADX, it's already too late. That's not going to help you. So this particular filter hurts you. So again, the point is a lot of people just put these filters in right at the beginning thinking, hey, a filter is going to help me. The ADX, oh, hey, that was Wells Wilder years ago. Everybody uses it. Well, doesn't mean it necessarily is going to work. Here's another one, RSI filter. So this one, I'm just using it real simple. I'm going to use it with a 50 threshold. Hey, I'm only going to buy if it's above 50. I'm only going to sell if it's below 50. Here's a couple trades. One trade that happens, one that doesn't because of the level. And when you put this in TradeStation, if you say the RSI is above 50, yeah, then I can do the breakout buys. If it's below 50, then I'm going to do the breakout sell shorts. So fairly simple. And again, not a huge difference, but having it off is actually better than having it. So there's another case where the filter that we thought was going to make things better, certainly an RSI is something that a lot of people use. And in fact, exactly the way it's written, I use it on quite a few strategies. This is saying on this strategy, it actually makes it worse. Ugh, well, that's not good. So the point here, relative to making things better for your trading, is maybe filters with these standard indicators aren't the answer. Maybe it's minimizing the number of filters you use. And certainly that also helps from a curve fitting point of view, which, I'm not even showing you out of sample results. I'm just showing you actual just in sample backtest results. But minimizing the number of filters certainly would help with that too. But the bottom line, again, is you got to test. You always got to test this stuff. That's the big thing. Unfortunately, this is what most people have happen when they go to test. They get stuck on this hamster wheel. What do I mean by that? Well, they create their strategy, they optimize it, they review the results, they add some filters, take things in and out, put the stop loss in, take it out. They optimize again, review it, add more filters. And eventually, what a lot of people end up doing is they end up with a great back test. It's such a smooth equity curve. This is awesome. Then they trade it live, they lose money, and they start all over. You know, they're right back where this hamster is going around this wheel. He just keeps going around and around, and you keep doing the same things over and over again. And if that's you, you got to think about what you're doing, and that, hey, maybe that's not the way you want to do things. Do things differently. That's how most people do it. Do it differently. You know, don't build, optimize, and review, and then improve, optimize, and review, and keep going on that cycle. When you build strategies, when you take these entries and create strategies, you actually want to minimize your optimization and minimize your complexity. That's the key. So I'll talk a little bit more about the framework I use in a few minutes, but that's what you want to do. You want to minimize how complicated your system is. You want to minimize the amount of testing you do. You know, in this case, you want to minimize your filters. Okay, so let's look at a third one. Now, you know, the first two, if you had them in there, maybe they don't even help you. What about this kind of thing? So what is it, first of all? Well, what I'm doing is I look at the long-term and the medium-term price action, and I'm only going to take buy trades if I'm in a bull market, and I'm only going to take short trades in a bear market, okay? And there's also a flat period in there in between. You know, I might not be long or short because it might not be a bear or a bull. I also include, I want to trade when there's above average volume and there's a smaller than average range because it might be contracting a little bit. So that's what the filter looks like. If you want more information on that filter, I have a free article on my website all about this thing. It's a really long article, a ton of results. You just go to KJ Trading Systems, click on resources, and you should be able to find in my articles this bull and bear regime trading. It's definitely worth a read if you're interested in this type of filter. This is what the code looks like in TradeStation. So I'm saying if the long-term momentum's up and the medium term, I'm calling this a medium term momentum's up, and I have higher than normal volume and a lower than average true range, then this BBR, which is bear bull regime, is a 1, meaning you're in a bull trend. And if it's the opposite, excuse me, you're in a bear trend. So I just add that to it, and I'm saying, hey, if I'm in a bull trend, then I can buy. If I'm in a bear trend, then I can sell. Otherwise, I'm not doing anything. So that's all the code is. So let's see how that works. And this one kind of blows you away. Remember, the 3.84 is what we're comparing it to. When I use this filter, this regime, bull bear regime, almost a factor of what, 8 or 9, that improves my average return on account. So it definitely supercharges things. It's pretty impressive. And then if I break it down and look at different stop levels and profit targets, you can see if you wanted to go back and add the stops, just having this filter in gets you a ton better than that original result, even if you use pretty tight stops. So this type of filter is really helping you across a wide range of different stops and targets. So it's pretty nice in that respect. So that's a real good one. And you know, what have we learned overall? Okay, well, maybe not having stops and targets, you know, it's scary for some people, I realize it, but maybe not having them will give you better performance. It'll make your entries perform better, okay? Maybe not having filters or minimizing the number of filters you have, maybe that would improve things too. So it's something to look at, and that's kind of the big point here. I found this for a breakout strategy. I suspect the same thing would hold for a lot of different strategies, but maybe not every single strategy out there. And then having that bull bear regime filter is really a nice way to improve a strategy, and it probably improves quite a bit of strategies, because what you're doing is you're saying, well, hey, wait, I don't want to take short trades when the long-term trend is up. It's kind of like, think of US Treasuries, the 30-year bond. It's been in an uptrend for how many years now? Is it really wise to try to go short? You're hoping you're like picking a top. No, it's probably better just to wait for some kind of pullback or something and take a long entry. That's the kind of thing we're talking about here with this bull bear regime, and it works pretty well. But the big caveat here is you've got to look at it with your own entry. Don't just say, oh, hey, I'm going to use this because Kevin did it with breakouts, so therefore it'll work everywhere. You got to test it yourself, right? And it's got to be part of your development process. There's a ton of different testing that I do before I put a strategy live. Things like walk forward testing, Monte Carlo testing, correlation testing. It's one piece of the puzzle. You got to do all that. And the entries and exits are important, but it's really what it comes down to is it's the process you use to test. And I can't emphasize that enough. You could have the greatest entry in the world, but if you test it improperly, you're not going to get the results you want, or certainly the future performance that you want. Testing is the key to being a good algo trader, or if you're a discretionary trader, it's the key to having good rules, good ideas to trade with. You test them and evaluate them. This is my process. It's a trademark process called Strategy Factory. Takes you from goals all the way through real money operation. So it's a step-by-step process. I'm able to be pretty methodical about what I do. Can you do something like that yourself? Well, yeah, absolutely. What I did when I developed mine is I did this on a whole bunch of strategies. I got a lot of real-time results to validate it. If it didn't work, I went back to the drawing board, and you can do the same thing. You just have to have enough strategies that you test and enough real-time results, because at the end of the day, having a good back test doesn't really mean squat if your real-time performance isn't there, right? So you can definitely develop your own process. You just have to have enough data and enough tests. You can't test one strategy and make conclusions about every strategy in the world. And that's exactly what I'm saying today with what I showed you. Say, hey, you can't just take this and automatically use it. You can take it and test it and verify it on whatever you want. And if it works, well, hey, great. But the key is to test. So kind of wrapping up, and it looks like I'll end right on time. If you want to improve your entries, evaluate if you're using stops and targets. Look at those filters you're using. Maybe you don't want to use them, or maybe you want to make them non-standard. Don't do what everyone else is doing. And feel free to use this bull and bear regime filter that I kind of gave you the code for. But the key is to properly test before you start live trading. That is the absolute key. And it's the two words there. Well, really, they're all important. You got to test. You got to test properly, and you got to do it before you go live in the markets. I mean, that only makes sense. So if you want to learn more about what I do, how I do things, some of my articles, that kind of stuff, just go to kjtradingsystems.com/free festival, and you can get a mini S&P algo for free, and you can at least see how I do some things, and you can learn about how I do what I do, basically, which is algo trade and develop algo systems. All right, so thanks everyone. I appreciate you sticking around and listening.